Welcome to this segment of GTM Training Shorts presented by GTM Training Institute, your source for comprehensive income tax compliance and tax provision learning and development. My name is Frank Nieves, Director and Practice Leader. Corporate tax can be complex, and understanding its terms and concepts can be challenging. GTM Training Shorts aims to simplify complex content into concise and comprehensible segments. In this short, we will address the question, what is a valuation allowance? Listen to Sanandra Miller, Tax Director in our Wayne office, as she explains.
The concept of a valuation allowance can be thought of as a reserve that is set up against deferred tax assets. Deferred tax assets are tested for their realizability and determined if a valuation allowance is needed against the portion that will not be realized, meaning the portion that the company will not realize a benefit on. You can think of this similar to accounts receivable and a bad debt reserve. When a company realizes that they're not going to be able to collect their full account receivable, they would set up a bad debt reserve for the portion that's uncollectible. The same applies with a valuation allowance. The portion of the deferred tax asset that the company will not realize a benefit on, they set up a reserve against it, the reserve being the valuation allowance. An example of this would be if a company generates a capital loss that can be carried forward, it's only going to have value to the extent that there is a capital gain that can offset this capital loss. If the company doesn't believe that they're going to have any capital gain in this carry forward period, then they're going to book a reserve against this capital loss since they're not going to realize the benefit on it. And this reserve would be the valuation allowance. A valuation allowance is required if it's more likely than not a greater than 50% threshold that some or all of a deferred tax asset will not be recognized, meaning that the company is not going to realize a benefit or some or all of that deferred tax asset. Companies are required to test the realizability of their deferred tax assets. Just because a company sets up a valuation allowance doesn't mean that it's going to stay the same forever. The necessity of having a valuation allowance and the amount of the valuation allowance can change over time as the company's business operations change. So a company needs to continually test the realizability of their deferred tax assets in each period. An example of this would be if in year one, a company has a capital loss carry forward of $100,000 tax effective. And the company does not believe that they're going to have any capital gain going forward. They're thus not going to realize the benefit on this capital loss, so they're going to need a valuation allowance against it. They're going to debit the deferred tax asset for $100,000, credit the deferred tax expense for $100,000 to set up that initial asset. Now they're going to set up the valuation allowance against it. So they're going to debit their deferred tax expense for $100,000 and credit the valuation allowance, the contra asset account, for $100,000. If we fast forward to year two, the company now has generated a $50,000 capital gain. So they're now going to be able to realize the benefit of some of that initial $100,000 capital loss. So they're going to now reduce their valuation allowance because they can now get a portion of the benefit of this. So they're going to debit the valuation allowance for $50,000 and credit the deferred tax expense for $50,000. Whenever you increase or decrease a valuation allowance, this will impact your tax expense, and it will also have an impact on your effective tax rate.
For more information on how we determine if a DTA is more likely than not to be realized, check out our corporate tax provision programs. Scan the QR code or email me for additional information or to suggest a future topic. Don't forget to like and subscribe below. Thank you.